Since the 1980s, real estate prices have grown 700% faster than average wages. And in major cities like Vancouver and here in Toronto, it's much worse. It's no wonder, knowing these numbers, that so many people have historically thought that investing in real estate was ultimately a sure thing. I mean, it basically has been for 40 years, but that may all be changing now. Today, we're exploring the shift in this trend and also the dramatic update from the Bank of Canada regarding mortgage rates for the rest of 2025. If you're renewing or you're thinking about buying a home, you'll definitely want to hear that segment. We had essentially a catastrophic update in the unemployment numbers. And we also want to talk a little bit more about the ever evolving, collapsing condo market, especially in Toronto, but certainly here in Vancouver as well. It has been quite a shakeup in real estate just this last week. Let's take a closer look. Off the top, we want to discuss that 700% rate that I just opened with. There's a reason. There's a reason that so many Canadians feel, or at least felt, like housing prices would just go up forever, and that things like investment condos have been one of the safest investments available. And also the reason that young people today, well, they feel it's essentially insurmountable to buy that first home. The reason? Well, since about 1981, real estate prices have increased 7 times, 700% faster than household wages have. The actual numbers demonstrate just how unfair this really is. From 1981 all the way up to 2024, the median real hourly wage for a full-time job has only increased 24%. That equates to just 0.53% when we look at it on an annualized basis. For part-time work, oh gosh, it gets even worse, increasing only 6% over that same 43-year period. Meanwhile, Canadian real estate prices, adjusted for inflation, have increased 163% over that same time period, even after accounting for the recent price drop we've seen since the 2022 peak. That equates to a 700% difference between real estate prices and wages. And yes, I am talking about Canadian real estate. Understandably, it gets much worse if we were to relate those to Vancouver or Toronto prices, as those are well above the Canadian average. This really demonstrates the divide and how difficult and frustrating it is for today's youth when they look at these real estate prices compared to wages and what they've done over the last 4 decades. And also why investors, well, they felt this is one of the fastest and safest and highest returning investments available in the country. So it's a bit of an unfortunate wake-up call, but when you look at history and you look at what's happened historically, you get an idea why people feel so comfortable about investing in real estate. But then as things change, well, again, their sentiment and outlook may change as well. Ryan, you got some thoughts on this?
Yeah, you're absolutely right. When you compare the growth rate for income to the growth rate of assets, it's not even comparable. And I know, like you do, Dan, we look on social media and we read the comments everywhere. We hear it from millennial buyers, how they say, oh, their parents were able to get in at a reasonable price, and they were able to buy their first home at 25 or 28, even when interest rates were high at 12% or whatever. But that house was $180,000, or about 3 to 1 in terms of income to asset value. I think what this reminds me of is it makes me feel like we're in a feudalist class. It's like, unless you have a family that has property, your ability to acquire property now is almost out of reach entirely. And certainly the direction that we see the new Liberal government wanting to take housing in Canada, it's got a lot more to do with state-owned property providing housing, as opposed to income or wealth-generating property that liberates Canadians and provides sovereignty and freedom on all of those things. It's kind of crazy. I mean, neo-feudalism is basically this concept. It's where power and wealth are increasingly concentrated in the hands of small groups, similar to the hierarchical structure of historical feudalism. The concept suggests a decline in social mobility and the rise of a new class. And that is the billionaire class, Dan. And I don't know if you know this, but the fastest growing class of people in the US The fastest growing economic class is the billionaire class. For context, billionaires in the US, there's about 900 of them now. And last year alone, there were 74 newly minted billionaires. What's crazy is from 2020 to 2024, those 900 people accumulated $1.5 trillion in wealth. And that's just in the US. And it's actually accelerating. In 2024, billionaire wealth grew by $2 trillion in that year alone. So yes, the wealth divide is getting way worse and much bigger. Anyhow, with that said, let's move on to rate cut predictions. After the BOC held rates last week, markets quickly shifted and now show only about a 25% chance that we're going to see a cut in July and only one more cut for the rest of the year. That would take rates from about 5% that we saw at the end of May in 2024 down to about 2.5% by the fall of 2025. That would mean mortgage rates would bottom out in the high threes, probably. Not that much lower than where we are today. This is supported by the 5-year bond market that we see bouncing around at that 3% mark for 2025. And I do believe banks, central banks, especially the Canadian Central Bank, is holding off because they are unsure of where tariffs are going to take inflation. And they got spanked in the last round where inflation went up much higher. They thought it was transitory. Turned out it wasn't.
So ultimately what I'm hearing is if you are renewing or thinking about getting a mortgage, the rate you see today could very well be the rate that you can also get in like 6 months from now. They're projecting it to more or less flatline without any significant shifts or movement up or down. So plan accordingly. Now let's expand on the good old condo collapse that's been taking place basically this whole year and the latter half of 24. In Toronto, of course, it keeps on getting much, much worse. If you can believe it, in Toronto right now, the pre-sale condos, the amount available for sale in new homes, some are completed, some are still for sale, there is 58 months of inventory. That means today that if no new pre-sale product, no new pre-sale condos came to market, it would take 4.5 years at the current pace of sales to absorb all of the inventory available now. That would take us all the way to 2030 without a single new product coming to market. I mean, it's astronomical how high, how many are available and how low the sales are. There's simply, no sales taking place, really. I mean, we shared the numbers last week and they're not improving right now. So as these new condo sales volumes continue to collapse, the trend of the development, the creation of new condo towers, well, it's following that trend downwards as well. And for those on YouTube, we're going to share one of the most powerful charts that I've seen in some time that really demonstrates that first, not only how low new condo sales are, but how closely correlated new condo starts are to new condo sales. It follows almost verbatim. It's like a crystal ball, and it's going to show us the collapse of future home supply. And I think that future home supply is one of the least talked about crisis that's quietly unfolding today. I mean, understandable, right? All the rage today, all the headlines today are about inventory, and they're absolutely correct. But we all know things cycle. And when you see that developers are completely sidelined at a time when historically they would be building, well, it's going to result in a shortage down the road. I can't give you a time frame, but we're looking at 4 to 6 years. It's going to be a very different landscape. And it's further demonstrated as well when we look at the total value of building permits. That fell very sharply in April, like 14% year over year. It marked the third largest drop for any month dating back 5 years. And while all segments saw declines, the sharpest drop is, of course, in the residential sector, right? They're also not building as many office spaces and industrial spaces, etc. So to get a little bit more clear on this, residential permits, they were down almost 15% year over year for building permits, totaling $7.5 billion in April. That's a massive drop. The bulk of this pullback, it's coming from multifamily, right? Your condo towers, as I talked about. That was like a 20.5% drop year over year. Where locally here in Vancouver, it's $1 billion worth of a decline year over year. I mean, these are big numbers. These are just really showing you how few homes are in the pipeline for the upcoming half decade or so. And like I said, 3, 4, 5, 6 years, this will actually be noticed. So there will be a cycle where historical housing shortage becomes pronounced once again, and I think it was interesting. So Doug Ford, the premier of Ontario, came out, I think it was just this last week, and in an interview on the news, he basically was pleading to the Bank of Canada to lower rates right away to help people be able to absorb some of this condo inventory that's just sitting on the market, because it's so pronounced. And it's funny when we look at political powers publicly displaying their intent to ultimately help the housing market, right? We see it time and time again, like prop it up, keep it going. And here's yet another example of a politician weighing in, trying to help the housing market in his local area.
I think it's not just that. It's also the fact that when you look at land transfer taxes and property transfer tax, if we're going to drop by $1 billion and they're going to drop by 7.4 billion, that's a lot of taxable revenue that has now disappeared and could upend their budgets that they were intending this year, right? So, this is a really big issue. It's a cascading issue, I think. And that's why you're going to see more and more of this. And there's going to be a lot of pressure on the Bank of Canada coming here. And I think you'll also see that in the US. And another reason I think we'll see more of that is when you look at the employment numbers, because Canada's unemployment rate increased to 7% in May. That's the highest in 9 years outside of the pandemic, and up a full 2% since the recent cycle bottom, which hit 5% in March of 2023. When you look at Ontario specifically, it hit 7.9%, basically 8%, nearly a full point above the national average. And it hasn't been this bad since COVID and the global financial crisis. Plus, that 0.9% gap versus the national average is the worst on record. Toronto's unemployment rate hit a whopping 9% in May. Outside of COVID, that's the highest since 2012. Thing is, it's not just about job losses that are creating this elevated unemployment rate. It's also due to aggressive population growth. I think I could be wrong, Dan, but I've read articles so far this year that have said, Canada's population since the start of this year has already grown by about 800,000 people, which is enormous. The payroll data from last month paints an even darker picture, showing a decline of 54,000 jobs month over month in March, after a 40,000 decline in February, now displaying employment growth only a hair above 0%. This is a level only ever seen previously in recessions, and yet somehow we're not in one. According to StatsCan, youth unemployment has reached the highest point outside of the pandemic in nearly 25 years. Students and recent grads are stepping into an economy marked by slow hiring, extremely high rising living costs, and fewer entry-level opportunities. For context, the age group from 15 to 24 is facing the weakest labor market conditions since the mid-90s. In May, the unemployment rate among returning students aged 15 to 24 was 20.1%. Looking back just 2 years, it was 11.4% in May of 2022. You can thank Mark Miller and Sean Fraser for taking away summer job options by allowing international student admissions to run so hot for so long, taking the jobs away from those people. This isn't just a youth issue, though. It's a signal. Economists often view youth unemployment as a leading indicator of a broader economic strain. Well, think about it. If there's no youth to literally fuel the next generation of workers, then our economy is in decline. When new entrants can't find jobs, it suggests weakening demand across the entire board. In the long run, an economy that fails to integrate the youngest workers is one that slows household formation, and by extension, all of the real estate momentum. We need young people. It can't just be people holding on to their properties and expecting them to go up forever. You have to have this other component. So while this might feel like a story for the jobs page, the ripple effect will touch housing, affordability, and the trajectory of home ownership for generations to come.
Lastly, let's touch on what's happening with rents across our country. Because for the eighth straight month in a row, average asking rents in Canada have declined year over year. May, the national average rent sat at $2,129 per month. And that's 3.3% lower than it was last year. The drop is being driven by a couple of key factors, some probably pretty obvious. Like we touched on, there's so much inventory on the market, and that includes purpose-built rentals. Purpose-built rentals are under construction, at currently record highs, and there's a ton of inventory that's going to be hitting that market shortly, adding more reprieve ultimately to renters and their rental rates. Ryan just said population might be growing, so my stat of it's actually slowing compared to history might be off. We'll maybe verify that for you next week, but it's likely outside of the 1.2 million a year we saw during the COVID heyday. And of course, broader economic uncertainty. When people are fearing for their bottom line, they're not out there improving their housing conditions as much. They're not looking for a nicer rental. They're just kind of maybe getting what fits their budget a little bit more reasonably. Purpose-built rentals, when we kind of break it down by which areas are dropping the most, the purpose-built rental apartments, their rental rate's down about 2% annually. Condos like your mom and pop are down about 3.5%. Interestingly, though, when we look at like detached homes and townhomes, the rental rates for those type of properties is down 7% from last year. I'm going to go with affordability. Obviously, renting an entire detached home, a lot less than renting a condo, and maybe people are moving and downsizing within their rental options. Let's keep in mind, though, as good as it is for renters to see that type of drop, we're still 12.5% higher than just 3 years ago. So that's a 4% annualized increase, which is quite a bit, and obviously outpacing current inflation. So, is this a turning point, right? With rents dropping for almost 3 quarters in a row and a ton of supply coming on, rent's going to drop further? Yeah, it's very, very possible, especially if the economic uncertainty and tariff talk, etc., continues for months, years, or whatnot. But what's the other side of that coin? I mean, the condo investors seeing rents drop in a marketplace where, the average condo at the average price, at the average mortgage, et cetera, is cash negative, and they're hearing that their returns are even lowering month over month. I mean, that segment of the marketplace is all but disappearing, right? It has been. And here's sort of further data that says, why on earth would you go and invest in a condo, even based on the last 40 years of that highly elevated appreciation rate? So that's kind of my update on the rental market. What is this? June 12th, we're recording this today. So we're like just over a third of the month through. And I just wanted to offer and supply a kind of a hyper quick market update because things move quick here, at least they can. Interestingly, sales volumes, they're trending only about 5% less than May of last year, and month over month, it's almost identical. So May and June numbers might be almost the same, and prices are basically stable. Median right now is identical to where it was 12 days ago. So what does that mean? I don't know. We're just kind of maybe grinding across the bottom now. Prices are stable, sales volumes are stable. Lots can happen, but kind of feels like we're just going to grind across what could be the bottom now. Ryan, any parting thoughts today?
I mean, I've got lots of thoughts, but whether or not they're relative to what we're talking about, I'm not sure. I do think, based on the current trajectory and where we're seeing ourselves, I think we're going to be just a slow grind that's likely down and to the right. I think we're still going to see some more softening. And I think that's due to the broader economy. I think that's due to things like employment. I think that's due to fewer higher paying jobs. And this massive wealth divide that we have, and coupled by the fact, I should say, that youth are struggling to get into this marketplace. If we can't find a way to get the youth into home ownership so they can start building wealth, and I don't mean living in a house in the city, I mean owning the home in the city, where they too can start to build some wealth, then I just don't know how we carry on under the current framework, we'll see like the likes of returns of foreign investment and all kinds of other things to keep things propped up, because I think that's kind of where we're at.
There you have it. That is what's important in Canadian real estate this week. We will be here next week to update you again on this ultra fast moving and always interesting industry. Thanks and have a great weekend. Bye.